A terrifying financial warning for 2022 from Michael Burry. Is Michael Burry right? Have we come halfway through this bear market? What does Michael Burry refer to as bullwhip effects? Is the economy really as strong as it appears? And what is the bottom line? We'll take a closer look at the economy as a whole and explain why he might be right and why we may be on the verge of another recession. Hey folks, welcome back to Finance Insights. In this video, we are going to find out the terrific financial warning for 2022 from Michael Burry. So let us dive right in. But before we do that, please hit the bell icon and subscribe to our channel to get every single update from our channel. Dr. Michael Burry is famous for making billions of dollars from his great shot during the 2008 financial crisis. He has strong opinions about the current market downturn and thinks we may only be halfway through this bear market. The most serious concern arises from a tweet made by Dr. Michael Burry a few weeks ago when the S&P 500 was trading around 1 to 2% lower than its previous closing price. In this particular tweet, he stated, adjusted for inflation, the S&P 500 is down 25 to 26% in the first half of 2022, the Nasdaq's down 34 to 35%, and Bitcoin's down 64 to 65%. That was compression on numerous levels. Earnings compression comes next, so maybe we're halfway there. We feel Michael Burry is right to be concerned because we believe there are certain crucial economic signs that point to an impending consumer recession and that the first half of the year is mostly a compression of multiples. One extremely fascinating sign that we've been watching is the recent evolution of both copper and gold, as they have historically been great indicators of the economic condition. Specifically, gold is often viewed as a safe haven for investors, whereas copper is the polar opposite. Gold typically performs well during times of inflation, economic and political unrest, and so on. Copper is known colloquially as Dr. Copper, or the commodity with a PhD, since it's seen as a particularly powerful indicator of economic health. Copper traditionally performs well when the global economy is expanding, and it performs even better today because it is utilized as a vital component in EVs, which often include twice as much copper as internal combustion vehicles. Copper prices have declined by up to 30% in the last 3 months, while gold prices have fallen by up to 13.3%, despite a record year-over-year inflation report of 9.1% earlier this week. Copper dropping by more than 30% in such a short amount of time suggests a lack of trust in a strong, healthy global market, but gold, on the other hand, may be an indication that inflation has finally peaked, or that it was an overcrowded trade, similar to energy stocks, which have also fallen recently. It's also worth noting that copper is more volatile than gold. So now the question is, what does Michael Burry refer to as a bullwhip effect? However, it fits extremely well with Michael Burry's story about a consumer recession occurring by the end of this year or early next year. Dr. Michael Burry alluded to this in a supply chain dissertation, particularly about how suppliers can suffer bullwhip effects. These bullwhip effects, as Michael Burry refers, implies a shortage of commodities at the close of last year, followed by overproduction, resulting in massive stocks today. We fully agree with Burry and believe that, while inflation has peaked, the United States will begin a severe deflationary spiral, causing inflation to decline by the end of this year, despite the fact that the Fed's still tightening very rapidly at the time when GDP is slowing and layoffs are occurring. This might lead to disinflation later this year, as well as a consumer downturn, and the Fed reversing or lowering interest rates sooner than predicted, so continuing the cycle. He verified this belief with a clever Twitter statement. What brings Christmas to July 2022? A Christmas consumer recession was caused by disinflation. But is the economy really as strong as it appears? Although very optimistic news was released recently, it indicated that retail sales climbed by more than economists expected in June, by 1% versus 0.9%. This provided investors with a favorable signal that, despite ongoing inflation, consumers are still strong. This statistic, however, had not yet been adjusted for inflation, which came in last at 1.3% month over month, implying that real sales were slightly negative. Michael Burry also mentioned the amount of ongoing consumer credit, which has returned to pre-pandemic levels. This occurred when customers' purchasing power was eroded as a result of negative real wage growth caused by high inflation. And it's not going to get much better when the Federal Reserve interest rates increase 75 basis points at a time, something that hasn't happened since the 1990s. That credit card debt will soon become too expensive. And despite trillions of dollars in stimulus spending, consumers don't appear to have managed to save much during this inflationary time. The personal savings rate has now dropped to 5.4%, its lowest level since 2008. Personal savings, according to Fed data, are also not looking promising. The quantity of personal savings for the first quarter of 2022 remains at 2013 levels after expanding rapidly over the previous 2 years. Currently, corporations may still pass along the cost of inflation to customers without negatively impacting growth, but that could change quickly as inventory buildup, consumers run out of money, and businesses and manufacturers are forced to reduce profit margins. And before you know it, you've got an earnings collapse. Wall Street may have priced in current inflation, which has presumably peaked, but falling earnings figures for the second half of this year have not been priced in. Analysts recently reduced their earnings projections for the second quarter of 2022, but not for a second half of 2022, according to FactSet data, which we believe contradicts the macroeconomic data. All indicators point to an impending economic slowdown, with the 10-year Treasury yield spread, for example, inverted at a negative 20 basis point. That's a pretty powerful inversion, and it might be a clear signal to the Fed that it's pulling up too hard and harming the economy in an effort to decrease inflation too soon. After the first quarter's GDP was negative, even the Atlanta Fed's GDP Now tracker predicts a minus 1.5% fall in GDP for the second quarter, indicating the U.S. may still be in technical recession. Nonetheless, earnings growth has not yet been revised downward, prompting us to fear that more misery is on the way. However, we believe that some immediate relief's on the way as favorable numbers on reducing inflation are released. This should also put the brakes on the Fed, making it less likely that it would hike rates as fast as it has in the past. After inflation came in at 1.3% year-on-year and 9.1% year-on-year in the latest CPI numbers, many analysts predict a 100 basis point increase while expecting a 75 basis point increase. However, the recent University of Michigan survey suggests a substantial reduction in consumer estimates for 5 to 10-year inflation, which has fallen the most since October 2020. Whenever it comes to long-term inflation, the Fed appears to be very worried about not being able to put the genie back in the bottle. The unemployment rate is, without question, the most essential indication that still points to a highly promising economy. Although this is often regarded as a lagging signal, we are beginning to witness a large number of layoffs, particularly in the tech industry. Where is Michael Burry hiding? Michael Burry's lack of confidence is what is set to happen in the economy is mirrored in the positions he's apparently taken. For example, in his most recent 13F filing with the SEC 2 months ago, we can see that he purchased a put option on Apple worth over $36 million. He may or may not have sold that position, but given that Apple has fallen by more than double digits since he declared his put option holdings, it's likely that he's already realized a profit. He also held holdings in companies with a substantial balance sheet and excellent FCF at cheap multiples: Alphabet, Booking Holdings, Bristol-Myers Squibb, Discovery, and Meta. Things could get worse before they get better, with the Federal Reserve tightening at breakneck speed, economic indications pointing to a recession, and profit expectations not yet bottom out. In the meanwhile, we and Michael Burry will reap the benefit of this buying opportunity, as trying to time a bottom is a perilous game. We believe that there are several opportunities to buy high-quality firms with strong balance sheets and robust business models that create a lot of FCF and can easily weather the next crisis. More crucially, if the Fed reverses course and begins decreasing interest rates faster than planned, as Dr. Michael Burry appears to be suggesting, that might provide a significant lift. And that brings us to the end of our video. Feel free to let us know what you think about it. And if you like the video, please leave a like and subscribe to our channel for more great videos. Thanks for watching, and we'll see you in the next one.